Okay, folks, who had fun today? We need to give an update on the market and plays like Atter, which went real crazy today. Does it have more room to run, and should you lock in profits? And then lastly, for the main entree, I want to discuss with you a very, very unique situation that a lot of retail traders are picking up right now, and the media is starting to acknowledge as well. I haven't seen anything quite like this before, and I think you're going to want to hear about it. Before we get into it, the only thing that I ask of you in return is that you hit that ravishing like button, and also don't forget to subscribe either. Okay, overall market, yeah, the Dow showing some strength, and the NASDAQ looking a little dreary because this is inflation week. We have a big inflation report coming this week, and when inflation expectations start getting higher, people are like, okay, well, we better be selling our NASDAQ tech plays. We better be pouring into the Dow. And then next week, when you start seeing bad economic numbers, are like, okay, we got to start selling the Dow, got to pour back into the NASDAQ tech plays. The market simply does not know its right foot from its left butt cheek right now, and you just got to let it do its thing. But in totality, overall market not doing much. But squeezers, oof. Atter was a nice win today, capping off a more than 50% run in a single day. More into the after hours, going as high as 1993. Last week, we talked about how whales buying Atter and whales shorting Atter were on a massive collision course. And how fast lower priced shorts are getting crushed on this. And with Ortex reporting estimated short interest dropping, I would gander very strongly that a lot of the weakest shorts in this play got killed today. That being said, the vast majority of short sellers are still in this, and I would gander that short interest is probably going to go up again. It's just going to be at higher and higher price points. But anyways, how did we find this play? Well, for context, the first time that we briefed on it was on August 30th, and basically saying, hey, I like it, I like the setup, but if this isn't the area where we hold our upward direction, well, we're going to have to be a lot more patient. Guess what? We did have to be more patient. And the next time we briefed on it was on the 7th. We said, seeing high retail interest on many forums as a short squeeze candidate, looking for hype rallies this week to heat up. And of course, they did heat up in a massive, massive way. Now today, it's gone all the way up to 1993. We put in the work before it was running and while it was running to keep up with it, to identify what shorts were doing, what the previous patterns were. We talked about whale inflows and the pricing pressure that has in a stock like this. And we talked about heightening retail sentiment. At the end of the day, these are all characteristics that made the run much, much more likely, but there's never any guarantees. How can somebody predict exactly what longs are going to do and when they're going to come in? You can't. So what you do is you find the probabilities that make sense, and then you see if the probabilities play in your favor, controlling your risk if they don't. Now moving on with my thoughts and predictions, Atter right now is extremely vulnerable to whales pulling the rugs on it. And so in effect, I don't believe this is a play that you want to dime in hand. If it sells off, it may not come back. Quite frankly, it's impossible to know whether the whales are happy with their gain or if they want to get out at twice the current price. So what I said this morning is pay very, very close attention to what happens when it does pull back. Is it able to show more proof of concept of being able to rebound into an upward direction? Or is all that money that propped this up just leaving and going home? Because if the money continues to flow in and retail continues to pick this up and short interest continues to stay pretty high, well, then you get more running, right? I say if you want to make a more bullish case for this, wait until we get more proof of concept. And if you want to continue playing further momentum rallies, why not set a trailing stop loss, right? Okay, next. I've been decently happy with SPRT. The sell the news sell-off did break the 20 support level, but the closer this gets to $15 or $10, the more you can make a case for a low-risk short squeeze opportunity when we get a rebound. Short sellers continue to be convinced that this is going to be a gold mine, with short interest rising 5% today to a mind-blowing 96% estimated total short interest. If SPRT doesn't keep plummeting like they want it to, and it instead finds a consistent level of support, well, these short bets will prove to be overconfident and will age very poorly. And tomorrow is expected to be the final stage of the merger, from which the ticker should change over from SPRT to GREE. In terms of reactions to that, I'll keep you updated in tomorrow's morning briefing, but all else considering what we want, the best case scenario for this right now is to find a consistent level of support. We've seen time and time again that when stocks prove that they have a set level where they can find support at, where they can stay consistent and stable at, then the retail traders start connecting the dots and say, okay, well, all these shorts are getting screwed right now, and they start buying, and then you start seeing what we call momentum squeezes. I don't believe that this is over yet, and I have 8.92 million reasons not to believe that. Okay, next, Ooga Booga AMC. So AMC took some more ground today, continuing its relentless over a month-long uptrend and holding very steadily in the 50s, which is excellent. AMC actually had some fun fundamental news today. One of the things that we've been talking about is this idea that movie studios are the ones that decide whether movie theaters are going to continue to see audiences. And the reason this is relevant is because today Disney announced that they're going to release 2021 films exclusively in theaters, which is hugely positive for stocks like AMC. Of course, AMC is a short squeeze play, but any sort of good, positive, fundamental news is something that riles up AMC ooga boogas and causes more buying pressure. Okay, so a certain commodity is getting very, very hot. Prices are up huge. The media is starting to cover it. Every single retail trader, including your mother and father, are going and saying, son, daughter, how do I buy this? We've even got oodles and oodles of comments on the channel for me to cover it. Meanwhile, stocks in this industry are up huge. You have CCJ, DNN, UEC, Eura, and quadruple U just going parabolic. What is this industry? Well, it's uranium. People are speculating already that this is going to be like last time when uranium had a similar setup in 2007, where not only did uranium prices skyrocket, but some uranium mining companies and uranium related stocks went up thousands to tens of thousands of percentage points. And on top of that, the quick version of the story and where retail traders come in is that not only is there a shortage of uranium, but there's a big fund that's going and trying to buy up all of the available uranium on the market, hoping that it could force utility companies to buy it back at a huge premium, which of course is becoming a self-fulfilling prophecy because it's creating a shortage that's much worse than would have organically been there. The fund that is doing this is called the Sprott Fund, and what's very, very interesting about this is that you have uranium analysts like Kevin Bambroch that, despite the childish Twitter profile picture, predicted the last uranium spike and has served the commodity industry as a leader for decades. And what is he saying? Well, he's speculating that if just 1/10 of the capital that flowed into, say, GME went into this uranium fund, it would drive the physical price of uranium north of $200 a pound in the upcoming months, and as a result, 10x all of the uranium stocks, which of course these stocks, like I just mentioned, have already gone up oodles and oodles, largely driven by the purchases of the Sprott Fund. But why is this prediction starting to go viral? Well, here's the thing. Because the Sprott Fund is taking away availability of uranium on the market, buying more allows it to buy more of that uranium and allows it in turn to actually have its own uranium be worth even more, and forces the people that need uranium to either come to the table now and pay these elevated prices, which cause them to go up even more, or pay whatever the price is in the future, which again, if they take all the supply, could cause prices to skyrocket even higher. But of course, there's always more to the story, and it is a bit of a rabbit hole. But let's just talk what uranium's used for. Uranium powers nuclear energy plants, which are clean energy until they aren't. And essentially the bull case for uranium goes, nuclear energy is increasingly relied upon on cities and grids around the world, especially in China and India. About 20% of all US power is generated from nuclear energy. And at the same time, there's a set number of nuclear reactors who need uranium in order to be powered. It means you have a set number of demand. Problem is that a lot of the uranium mining companies shut down during COVID. Some have had rolling shutdowns, and overall they haven't been able to meet demand. There's been a supply shortage. And to make matters worse, utility companies have been understocking on uranium for the better part of a decade. And global backup inventories are dropping fast as well. At the same time, where a push for cleaner, reliable, and cheap energy is growing massively. But it gets deeper here. See, if you're a commodity purchaser, you probably don't want to deal with the volatility of prices of your commodities. So you buy what's called a contract. And with uranium, you have a lot of short-term one-year contracts that are set to expire in 2022, in the beginning of 2022, which means that all these nuclear energy companies are all going to, in theory, be bidding for uranium at the same time at that point. Now, without any outside pressures, they seem to be doing fine. They didn't expect to have a really, really bad problem next year, and a lot of commodities overall are going up anyways. But what has complicated the process is that the financial markets are starting to speculate on this and trying to force a squeeze, trying to force them to pay up a premium in order to get this uranium. And fearing this is going to get worse, a lot of them are coming sooner than expected and buying uranium because they're panicking, thinking they won't be able to get any decent priced uranium 6 months to a year from now. Funds like Sprott Physical Investment Trust, who are buying up uranium massively right now, are not only anticipating a huge payoff, but they're making their payoff more and more guaranteed as they secure more and more of the market. At least that's the story and the speculation that's being spread. But what is my opinion? Well, my thought process and my research looking at the data, I would conclude that a lot of the story is true. There's more demand for uranium Then there is supply. The financial market is starting to take a lot of that supply off the market at a time where demand is supposed to go up. And the way that I see it, it's almost inevitable that the situation gets more and more dire. Eventually, if this keeps going up, uranium suppliers, whether that be people who hold uranium in reserve or miners, they're going to make a lot of money at elevated levels. But of course, the risks with this are plenty. Right now, I would argue that its run-up is specifically driven by funds like Sprott, who are taking supply off the market and causing more people to go in and take supply off the market. But if that buying pressure takes a pause, this could have a massive cool-off as miners are able to catch up a bit to demand. And as fears ease and people stop panic buying, this could become cascading. However, that's the bear case scenario in terms of a risk in the next couple of weeks to months. But when it comes to bigger picture, when you're looking at this data, demand outstrips supply. And with financial players more and more in this market, it seems like the upcoming quarters are going to be extremely contentious for people wanting to buy uranium, which means that we're probably going to have a lot of opportunities to play these mining stocks. I'm just saying we should be very cautious in the present. Is there any truth to this billion-dollar fund that's buying uranium and the effects that retail buying it would have in terms of forcing a squeeze to happen sooner? It seems to me there is, but I wouldn't count on that specifically. We're in the early stage of a massive battleground on this, and when you start getting into newer and newer highs, this gets real hairy real quickly. Anyways, folks, that caps off the video. If you have any questions, feel free to reach out to us below or join us on ZipTrader Circle. If you'd like to learn how to trade with our step-by-step lessons, our private chat, and of course our daily morning briefings, well, I'll go ahead and put a link to ZipTrader you below. Coupon code FUDSTOPPER50 will get you $50 off before checkout. If you're wondering what broker to trade these stocks on, well, we like to send new traders over to Webull, and they will give you 2 free stocks when you sign up and deposit with just $5 using our link below. Anyways, that caps off the video. Have a good one, and I'll see you in the next one.